It's still not really a high rate, but you get these algorithms that move money from stocks into bonds, into cash temporarily. I mean, when you see things like REITs go up and utilities go up, the market's signaling to you that maybe this is a slowdown, Mike, as you were saying. But in our view, I think it's just more kind of a reset. Because if you look at real growth, you look at consumer confidence, business confidence, all this to us is leading to a better, if not good, economy, which should then let kind of the financials, cyclicals, other stocks, other sectors do well. But right now you've got that pause. Plus you got earnings season coming and higher input costs. You know, companies are going to come in.
Is that a
PPG, Delphi last week. So that's going to kind of give people a little bit of pause because they say, hey, do we have another alternative here? We're not just at zero interest rates. But I think down the road, that's a lot more positive than negative.
That was you I was channeling with the good news is bad news, Joe. Those were your comments. We're back in that environment. But you point out, as many have, that historically rising rates aren't necessarily bad for equities. It can actually be good. But then if it is good, small beats large, value beats growth, cyclicals beat defensives, and commodities and real estate outperform. Those are all things that you're predicting now, or these will be features of the future?
I think they'll be features of the next leg of this bull market because
historically, rising rates always precedes recessions. It happened in '94. It happened in 2001. It also happened in 2007 and 2008. It's going to be no different this time. These people are purposely falsifying misinformation to have people continuously throwing their money into the market so that way they're stuck holding the bag once these guys pull out. It's just not right.
Because I think what we can avoid here is higher rates. And there's a lot of arguments out there that say Treasury yields can't go higher because of whether it's aging baby boomers or because you've got all this sovereign debt outside the U.S. that's a much lower yield, so it's effectively going to put a cap on the 10-year Treasury yield. And I don't think that's the case. I think we're in the early stages of a secular bear market in bonds, one in which we're going to see rates continue to go higher and higher. And I think we could see the 10-year Treasury yield at 3.5% to 4% in over the course of the next 12 months easily. So the question becomes, what outperforms in an environment where you do get secular inflation and secularly higher rates? If you go back to the 60s and 70s where you did have that inflationary pressure, and you look what outperformed, it was assets that could either grow faster, like small cap over large, or it was segments of the market that had pricing power, like cyclicals over defensive, or commodities, or real estate. And so I think investors are continuing to allocate as if we're in this environment of unlimited QE and lower rates. But I think what they have to wake up to is that we've got real inflationary pressure that's out there. And I think wages are sort of the epicenter of that. And that's going to cause yields to go higher and higher.
Joe, nobody else is really thinking that at this point. If you look at the Russell 2000, it's testing its 200-day moving average, tempting to fall below that. Why does nobody else see this?
Investors are almost, I think, still allocating according to the rearview mirror. If you look at, the bond market in June of 2016, the 10-year Treasury hit its, all-time high price, where the 10-year Treasury yield hit 1.35%, so all-time low yield. Since then, it's gone from 1.35 to 3.25%. Investors have pulled about $130 billion out of U.S. equity ETFs and mutual funds combined, and put over $600 billion into traditional fixed income. So investors are looking at this environment thinking, stocks are bad and bond yields are going to start to go, back down. Yeah. So I think investors have this recency bias where they're still afraid of what happened during the great financial crisis, and they're not willing to acknowledge that these are the conditions in which just to be bullish.